All right, good evening, everybody. We'll go ahead and kick things off. We'll go ahead and kick things off. Welcome to tonight's webinar. We're going to be talking about setting stops and profit targets, two very important parts of trading that every trader needs to be very good at if you ever plan on being successful. Where to cut your limits, where to set your limits, and where to get out, take your profits. My name is Thomas Wood. I am the Director of Trading Operations at MicroQuant and also the host of the Futures Trading Room if you don't know who I am. And let's go ahead and dive right in. Before we really get started, just a quick general risk disclaimer. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. And then along those same lines, we're required to show you CFTC Rule 4.41, just a hypothetical disclaimer. Obviously, if we're showing you things from the past, it's in the past, so it's easy to say, yeah, it looked like it, or yeah, it worked great there. Doesn't mean it's going to work great every time. But obviously, I wouldn't be telling it to you if I didn't have a lot of confidence in it. Tonight, I'm not going to do a PowerPoint or anything. I'm just going to bring up TradeStation and show you how this works. I'll show you a couple different indicators you can use for setting stops and for identifying profit targets. We should be good to go. If you ever have any questions throughout the webinar, feel free to ask me at any time. I'll do my best to answer as many as I can. If I don't get your question answered, feel free to send it in to support@microquant.com, and we'll try to make sure we help you out there. So without any further delay, let's go ahead and pull up TradeStation and dive right into setting stops and setting profit targets. Alrighty, just want to verify really quick that everybody can see TradeStation. It's a gold chart. On a 1,000 tick chart has a couple different indicators. You can see all the flashing lights on the right from my radar screen. Everything. All right, good, great. Okay, good deal. So I have a couple different indicators on here that if you're not familiar with, I'll go ahead and explain them to you. First off, we have value bars, which are taking your traditional value chart and superimposing it over top of a price chart. So upper yellow is moderately overvalued. The center green area is fair value. The lower yellow is moderately undervalued. And then the upper red and lower red are significantly over and significantly undervalued, respectively. Then I also have a stochastic fast, just a stochastic oscillator showing you overbought and oversold areas. And then we also have the MQ market strength indicator. What the MQ market strength does is it basically measures how far a market typically moves from peak to valley, basically. Blue line, the blue line here, the solid blue line is the buyers, so how high it goes from a rally, from the peak to the valley. The red line is the exact opposite, how far down it goes from peak to valley. Now, there's a couple different ways you can use this indicator to help you with stop placement. All right, as long as you're timing your entries properly, with all the trades that we place in the trading room and all the different strategies that we use, we're always trying to make sure that if we're buying from undervalued, and if we're selling short from overvalued. So we want to be on the right side of value. Now, a couple things you can do to see how accurate you're going to be with your entry is using this MQ market strength. As we all know, markets tend to do the same thing. They repeat themselves. History repeats itself. Now, it's always changing. And that's not saying that the exact same thing that happened 10 years ago is going to happen right now, because the market's always changing, always evolving with different strategies that are being traded, different market makers, etc. However, what I am saying is that you'll find patterns that occur over and over and over again. And one of the interesting things that happen is the typical rally before a consolidation period a lot of times will be right around the exact same amount. So gold's a really good example right here, and we'll go through and look at whatever market you want to look at. But let me fix this. If you look here, you look back on your MQ market strength, you see 1, 2, 3, 4, 5, 6 different peaks just in this little area here where the sellers or where the buyers came in and pushed prices all the way up to right about $6.36 or $6, let's call it $6.40 or $6.50 here in gold before the sellers came back in and pushed prices back down. So let's go back and let's take a look at where those points are. All right, historically speaking, where that market rallied $6.50 from peak to valley. And we'll do a couple more. So you see every single one of these, on average, the market peaked out right there, right about 650. You can see 650 right here, and you look over on the right-hand side of your MQ market strength, and it shows $6.50. All right, and you see every single one of those peaks, when it hit 650, the market consolidated. All right, so if you're looking to go short, you want your stop loss placed further away than that 650, okay? Because we know, okay, the average, going back historically over what we can see here, the average rally is $6.50. So if you go over here, and let's take right now, for example, so if we wanted to go short gold right now, which I'm not saying this is a sell signal or anything like that, I'm just showing you how this works. So we say, okay, the average rally is $6.50. We're trying to go short. Our market strength right now is only at $4.10. So technically speaking, it could rally another $2.40 before it hits that average rally. So if we're putting our stop here, we want to put it at least $2.50 above the current price. So the current price is $13.16.50, so we want to put it at $13.18 or $13.19.10 basically. About $2.60 above where we are. Does that make sense to everybody, what I'm saying here? So if we were going short, that means we want to have our stop $2.50 above the current price. So we're at $13.16.50. So you want to do $13.19 is where we want our stop to be. Okay? So that means what we have is this extra level of protection from where the market will typically rally to before going into consolidation. All right, I forgot who it was, one of my favorite quotes, and if you're in any of my workshops, any of the paid workshops that we do, whenever I'm talking about stop placement, you hear me talk about this, this saying. There's one guy that's in the Market Wizards book that says your stop should be placed far enough away that if it's hit, you know your trade idea was wrong. Okay, and I think that's a very, very good way of phrasing it. Your stop should be placed far enough away that if it's hit, obviously you shouldn't have been in that trade because you were wrong on the direction. But you also want it close enough that you're not risking the family farm on any trade idea. All right, so let's go back. Let's take a look at how this could have helped us. Okay, so we're going here. Let's say we're trying to get short either right here or right here. So we're watching this come up. We're watching this come up. We say, okay, we're right at about 630. Okay, so that's just a few ticks off this high. You're significantly overvalued. We have the okay then to go ahead and take our short, and we know that, okay, technically speaking, this could rally another 2 ticks to get up to 650 because we're at 630. So we take the short, we put our stop just a few ticks above that high, okay, above that average rally. So we'll put our stop up at a rally point of maybe $7. Okay, so we'd risk 7 ticks on the stop loss. That would have gotten us in right about there. Our stop loss would have been right up there, and we would have caught this entire down move here. Okay, which that's nothing to fret at. That's 23 all the way down to 18. So you're talking $500 a contract. That little tiny move right there. So not that little tiny technically. All right, and now this works. It's interesting. I really find this fascinating because this works actually on a whole lot of different time frames, on different charts, on different markets. It's pretty neat if you go back and you actually start looking at historically how often a market repeats its pattern. Okay, so let's go back. Let's take a look at gold. Now, the things you got to be careful of are the outliers, like this, gold shooting through the roof this morning, okay, from the announcement. Obviously, gold rallied a whole lot more than $6.50, and you can see it just went right up through the roof. But if you go back and you look back here, look at how many times $6.50, just about exactly, this market came up and poked before rolling over. So let's go ahead and let's put some vertical lines on it so you can see what I'm talking about. You see that? How many times this market at $6.50 works out pretty decently. Now, obviously, volatility does not always stay the same. So, yeah, NQ market strength is in the large bundle. Volatility does not always stay the same. So, obviously, you're going to have to adjust your prices. So here, when we come back here and we look, we say, actually, you know what? The market's been bouncing a little bit higher than 650. So let's go ahead and move this up to where these last two bounces were. So that way we know this bounce right here, we're looking at roughly $9.80 worth of a bounce. So our stop, we see the market coming up, we see the market coming up. We're just about to $9.80. We can take the short, put our stop just above that. Okay, so you're going to have to do a little math in your head and calculate how far away that is from the current price. And then you should be, as long as history repeats itself, safe to catch the down move, because the market shouldn't, technically speaking, rally past that point. And the same thing, by the way, goes for sell-offs. Let's take a look at a couple of these sell-offs. Remember, the red line are the sell-offs. Okay, so let's arrange some of these vertical lines so you can see where the sell-off is. And we're looking at right at about $8.30. This was yesterday's price action for these sell-offs. So you see here, right about $8.30, you got a nice little bounce. Same thing here, nice little bounce. Same thing here. Now look, this is what's interesting about this is you see it continued. It didn't just hit it and bounce right off of it. It actually kind of just continued to fall that whole time. But you would sell and then consolidate and then sell and then consolidate and then sell and then consolidate. And finally, the last one reversed and went straight back through the roof. But the thing you got to be careful of is you don't want to get caught in these consolidation patterns when that happens. But you can go back and look even back here. You had a few different times where that market, where gold sold off right to that $8.40 level and then reversed, and you got a nice bounce in the opposite direction. Yeah, this webinar is being recorded. It'll be uploaded to YouTube. All right, so pretty nifty way of determining how far a market can go or how far a market should go when you're looking to get long or short. All right, so when you're looking to place your stops, remember you're basically just placing it further than what the typical bounce or sell-off is. All right, does that make sense to everybody? What's another market you'd like to look at? Like I said, it'll work on just about any market. I like using tick charts for this a lot because a tick chart shows a lot more than a time-based chart does. 30-year bonds. Let's take a look at bonds. Alrighty, bonds. Obviously, you have the outlier from today, the huge rally, but you go back and you look here, and you're looking at, you pick the one market where I'm not going to be able to do the math in my head. But you're looking at 30 seconds, right? And you can go back and see how high the typical bounce is or how high the typical sell-off is, because you don't want to be selling. You wouldn't want to be selling bonds right now. Obviously, you want to be buying them because they've been trending higher all day long. So you go back and you look, okay, you have typical bounces about 0.27. Again, don't ask me to do the math in my head because I'm not going to be able to. So you go back and you look where that typical sell-off is, where it bounces off of that point. and you have 3 pretty decent entries where that market came right up to that 0.27 level, which again, I don't know what that is in 30 seconds. But not bad. You can go back and you can look historically back further. Let's just go back sometime in the past. I don't know when this is, so I don't want you to think I'm cherry picking specific days or something. All right, let's look right here on this day. Oh, come on. What are you doing? There we go. All right, so you're looking at an average rally here right around 3785. Okay, that's going off of these highs back here. So let's start taking a look at where this market bounced up to those high points at. I mean, look at those aren't bad. Okay, you've reached your average rally. The first one, all right, you got one down bar. You consolidated for a little bit, bounced up again, hit it again, and then consolidated sideways a little bit more. So the first one didn't necessarily reverse. Second one, complete reversal. Third one, same thing, complete reversal. Fourth one, complete reversal. Fifth one here, you actually blew through it a little bit. So this is where you get that outlier where it bounces more than the typical. But you can see just on this one day, you had 4 different peaks where they were all roughly the exact same amount of a bounce. Okay, let's take a look at a different market. Let's look at crude oil. A few people are asking for crude oil. Again, sorry, I can't do the math for bonds in my head. Converting that to 30 seconds. Let's take a look here. All right, so you're looking at the average sell-off. Okay, I'm looking at the average sell-off before you get a bounce. You're right at about 40.40, so you're at about 40 ticks. Let's go back and take a look at where the average sell-off was. And actually, this is downtrending. Let's change this. You don't want to be a buyer in this. You actually want to be a seller. So you want to know where the average bounce is to get short. And actually, it's still about 40. It's about 43 coming off of these 3 highs here and then this high here. So there's your average bounce right there. Here's your average bounce right there. You went a little bit higher than that. Here's an average bounce right there. Average bounce right here. So all of those would have been decent entries into this short as long as you were going, as long as you were going with the trend. Blue peaks are highs, red peaks are lows. Exactly. Red's the average sell-off, or how far down the market goes before consolidating. Blue's how far the market goes up before consolidating. So let's go back to a random day in the past. Again, I don't want you to think I'm just cherry picking these. And actually, it's still pretty accurate. Look at how many peaks you had. Remember, I haven't changed this line. It's still the one from today, and this is back on 925. So let's look at some of those average bounces right there, about 43 ticks before reversing. I mean, that's not bad if you ask me. Any of those were right in the area. They weren't quite at it yet. These ones went a little bit above it. But still, so you get the idea, right, on what I'm saying with this. You're looking at what the average bounce, if you're looking to go short, you want to be getting in when a market is just about to the highest point on the average rally, okay? If you're looking to go long, you want to get in when a market's to the average point on the average sell-off, okay? So let's change this around a little bit. Let's say we were looking to get long. We'll go back to another random day in history. Right back here. Where's this at? Well, actually, the market never went up there. That was downtrending day. So let's go here. It's kind of a choppy day, slightly upward. All right, so let's look at the average sell-off, okay? So right here, you have a peak there, you have a peak here, you have a peak here. You could also be looking right about there. You have 1, 2, 3 different peaks right there as well. So again, you're looking to be a buyer, so you want the sell-off to come to an end. So you want to see it reach the lowest point of the average sell-off, okay? There's a peak. Here's a peak. Here's a peak. Now that one continued down a little bit further. But all in all, not bad entries for longs on any of those. So if you're in an uptrend, would you ignore all the short signals? Yeah. If you're in an uptrend, why would you be going against the trend? Just follow the trend along. If you're in a downtrend, go short. Uptrend, go long. Again, this is just to help you determine where to place your stop. Okay, so let's go over here. Let's look at crude oil at the current price right now, wherever it is right now. All right, so we're in a little bit of a bounce. I would argue that we're trending lower. Anybody argue against that? I hope not, because crude oil has been trending lower all day long. So we're going to look at, okay, where's the average rally? And you have average rally right about 42 to 43 cents. You look over here on the right-hand side of your MQ market strength, you're only at about a 25-cent bounce right now. So if we were going short, that means we'd need to risk another 20 cents on top of where we are. So we'd go short with our stop 20 cents above where we are, so the stop would be at about 21. Okay? Does that make sense? So we're at 21 right now. We'd risk another 20 cents on top because we're at a 25-cent rally so far. Average rally normally lasts around 43 cents. So we need to risk another 18 cents, but let's make it 20 to make it easy. So the stop loss would be at 43, 98.43. Make sense? Pretty simple. Or what you could be doing is waiting instead of getting in right here. You wait until this market strength gets a little bit higher, up closer to that level, and then you can use a tighter stop loss. Okay, so you want it far enough away that it's not going to get hit, or that it's going to get you out if you're wrong, but it's not going to get hit if you're right on the trade idea. All right, let's go ahead. We'll take a look at another market. The S&P, sure. Take a look at the S&P. Let's use a little bit more than just 1,000 tick. Although the 1,000 tick looks like it works pretty good. Let's use a 2,500 tick, a little bit longer. Data request failed. Why is that? There we go. Alrighty. So you're looking at the S&P. So you're looking to get long. Okay, S&P's been climbing. So you want to see what your average sell-off is. I would argue it's right about 3.25. Okay, you look here. You have one peak there. These two peaks roughly at the same point. One peak right there. One right here. Right there. Right there. All right. So the average sell-off is about 3.25. 3.25 points. What is going on with TradeStation right now? It's actually about 4 points. Something's going on with my TradeStation. It's being all messed up. No, you don't take 4 points from the last swing low. You take 4 points. All right. So the average sell-off is about 4 points. Okay, you have 1, 2, 3, 4, 5, 6 different peaks, right at about a 4-point sell-off. Okay, right now we're at a $3 or 3.5 point sell-off. Okay, you see over on the right-hand side, right here, it tells you you're at 3.5 right now. The average is at 4. So technically speaking, we want to risk about a point here because that gives you 2 ticks beyond the average rally. You may want to do a little bit more than that. All right, so let's go back. Let's look at where those sell-offs occurred, where those 4-point bounces were. Let me know if you don't understand what I'm talking about, because I want to make sure everybody gets what I'm saying. Okay, so again, you're looking at your average rally or your average sell-off in the S&P using MQ market strength on a 2500 tick chart, right about 4 points. You have 1, 2, 3, 4, 5, I'd argue 6, 7, potentially 8 different times this market has sold off that much before bouncing again. Okay, and you see how accurate that 4-point sell-off is from peak to valley, basically. So if we were trying to get long the S&P right now, we go long, we say, okay, we're down 350, the average is 4, so we want to be a little bit beyond the average, so we may risk 1.5 points on this. Does that make sense? So that means you'd be risking 5 is where you'd be having your stop loss at, is 5. Does it work in trending markets? Yeah, these are all trending. I mean, these are all trending. It's helping you time your entries into the trends. That's why I like using tick charts. All right, so does that give you an idea on how to place stops? Any questions on that for using stop placement? If there's no more questions, then what we'll do is we'll talk about exit opportunities. Can I look at the DAX? Sure. We don't want to be using a 2500 tick chart in the DAX, though. We want to use something like a 500. Come on now. Maybe we won't look at the DAX. There we go. All right, so we have the DAX. Looking at the DAX, let's find the average sell-off or the average bounce. All right, so you're looking here. Your average sell-off, that actually looks pretty good. Right about, 24 points. Yeah, it'll work on any time frame you want. I like using it on tick charts, personally. All right, so again, we're looking at about the average sell-off. Again, we're looking at the red peaks, where the average number of peaks are. You're looking at about 24.19. Okay, so you go back and you can look at where all those 24.19 or 24-point sell-offs were, where you hit this level, and see what happened to it historically. So if you're looking to get long, you want to be getting long DAX right when you're about to be at about a 24-point sell-off, because then you know, historically speaking, you are close to the end of the sell-off. Okay? So how do you determine what's a good tick chart for each market? Different markets, it depends. Looking at this right here, you see how it takes a little while for it to swing from undervalued to overvalued? Okay, it's not just going to be right away. If you look at the DAX on a 50 tick chart, actually a 50 tick chart's not even that bad. If you look at a 10 tick chart, that's better. You see how this is literally, you're looking at 2 ticks and then you're undervalued to overvalued in 2 ticks. You don't want that. You see how choppy and herky-jerky this is? When you get into periods like that, you don't want your ticks to be like that. But as long as it's kind of smooth, you have smoother swings from undervalued to overvalued, and it kind of catches the wave right, if you know what I mean, where your swing highs and lows are pretty obvious, then you have a good tick amount set, and it just varies per market. There's no you have to use this amount for this market. It's really personal preference. All right, so that's how you can determine where to place stops. Okay, Again, you're looking at how far the average sell-off or the average rally is, and you're placing your stop just beyond that point by a few ticks. Let's take a look now at how to determine profit targets. Okay, you have a couple different options with profit targets, and one of them is using a stochastic. All right, now let's use, when you get days like today where the market shot through the roof and just trended higher all day long, basically from the announcement, it's going to throw these results off. But let's go to gold, and we'll go back in some random day in the past and see what we can find. Oops. At GC. There we go. Alrighty. This is using a stochastic for your profit target. Now you can either use a value target. These are just a couple options. You can use a value target, meaning you're looking from, if you're going long, you're trying to get long from undervalued, right? If you're trying to go short, you're trying to go short from overvalued. So if you're long, your first profit target can be overvalued because you're in it from undervalued. First profit target can be overvalued. Or you can use something like a stochastic. So let's add an indicator. Pull up the MQ momentum so I can identify some divergences for potential entries. Alrighty, so we have a bullish divergence right here. Bullish divergence here. Lower prices are lower, higher indicator. Okay, so you have an okay to get long off that divergence. If you're long from here, you can use an exit of overvalued. So if you're long from undervalued right there, you can be looking to exit at overvalued right here where you hit overvalued. All right, now the move continued on higher. That's all right. So that's one potential exit. You're still taking out, call it 1308 to overvalued at 1312, 1312.90, so 1313. So you're still looking at about $5 an ounce worth of a move. Not a huge move, but a decent one. This actually changes to a 500 tick. I like 500 better for gold. And again, let's just go back to some random day in the past. All right. So let's use this one for example instead, and let me change this up a little bit. Make these a little bit bigger. All right, so you're long here from the bullish divergence because you have undervalued, nice increase, strengthening of momentum. Prices came back down undervalued. So you're long there. Your first profit target can be overvalued, which you hit it on that bar. So you're in it from undervalued at, call it 1319. You hit overvalued at 1321.20. Not bad. Took out $2 an ounce. Now, if you want to stay in this trade a little bit longer, the other options you can use, two other things you can do. You can either use a stochastic oscillator, and you look at the stochastic, and if you see what a stochastic oscillator is doing, this is telling you statistically overbought and statistically oversold areas, okay? So it's saying, hey, the market's gone really far, it should consolidate. So if you look here, your stochastic, you want to look at these upper and lower limits on your stochastic, basically. So this is at plus 80 and minus, or at plus 80 and at plus 20. So you can use that as an exit opportunity as well when you cross above that point. Now actually on this one it actually ends up being just the very next bar. So that would actually have you exiting right here. The other option you can use is when it breaks back down below that statistically overbought, which would have had you exiting on this bar. Okay, so you broke above the statistically overbought. As soon as it starts coming back down below it, you're getting out. That's right here on this bar. That's the one you broke down below it. Okay, so first profit target's overvalued. Second profit target is the stochastic either breaking above the overbought or breaking back down through the overbought, so pulling back a little bit. All right, you can go back. Let's take a look at some other times that this occurred. Let me load some additional data here. Oh, we have a lot of data loaded. Let's go right here. So you're looking to sell gold, let's say. All right, let's say you're fortunate enough to, just for example's sake, get short gold all the way up at this high. Okay, just for example's sake. All right, so you got short gold from overvalued up here at 1336. Your first profit target could be undervalued, which that's at 1334. So that's only $2. So not a very big move, and gold did fall quite a bit more. Your second profit target or your first profit target could be when it breaks through that significantly oversold area, which is on that bar right there. Okay, so that gets you in it, and it's on the close of the bar, by the way, the stochastic is. So you're in it from 1336. That gets you out at 1330. So, okay, that's not bad. That gave you $6. The other one, the last one you can use, is the break back into fair value, or back into overbought, or back from that oversold area, which would be right there. And that would have been at the close of this bar. That close is at 1325.80. Okay, so not bad. You took about $11 out of it that way. So do you understand basically the two different options for profit targets? You're using either a value target or you're using a stochastic for when it gets significantly oversold or when that significantly oversold area starts to consolidate a little bit. A couple other things you can do for identifying when to exit. One of the things you can look for is a strengthening of momentum. So you don't really get a strengthening of momentum until you look at right there where you have this bullish divergence, equally low prices, significantly undervalued compared to the previous low. So here's your first low, here's your second low, here's your divergence, significantly higher. Okay, so that would have been an exit if you're waiting for the strengthening momentum if you were short. The other one you can look at using is you can use things like your MQ trend. So let's insert analysis technique. Oh, come on now. Pull MQ trend up there. So if you're short trading with the trend, you could hold it until your trend ends. MQ trend stays in it all the way over until here, okay, which is at 26. That's still, it gives it a little bit of room, but if a market really starts to trend, it'll keep you in it a much longer amount of time, okay? So you can use MQ trend if you're trying to trend follow. It just depends on the strategy you're using. One of the main things I use for profit targets is I look at my time-based charts, and I'll go off of support or resistance levels on time-based charts or dailies, such as trend lines or significant support or resistance points. All in all, pretty simple stuff. Just a couple different options. Again, this isn't really a super in-depth way of identifying exits, but it gives you a couple different options that you can use. Some that'll keep you in it longer, such as the MQ trend. I mean, look, there's gold trended all the way down, kept you in it all day long. Or using short-term swing highs and lows using your stochastic. All right, so any questions on those? Any questions on how to exit? Again, not super difficult. You're using, for your stop loss placement, using MQ market strength. For your exit, you're using either a value level or you're using the stochastic oscillator. Do I use stochastic? You've never seen me use it. No, I don't personally use the stochastic for my exits. I do know of traders that use it that are very good traders. It's not, like I said, my profit targets are normally based off of time-based charts, support and resistance levels, or dollar amount gains. So, all right, that's really about all that I had for today. I hope you all enjoyed it. Interesting thing that's going on right now before we end. Remember, we've been talking about the British pound in the trading room now for a little while. We're right up against that weekly trend line, though. I mean, we're right at it. So it's going to be interesting to see what happens here tomorrow and the next couple of days, basically. Snap mode. see how this plays out, whether or not we're going to get a break of the trend line or if it's going to hold and reverse back down. Again, that trend line is right at 62.55, and we're at 62.34 right now, so not that far off. Something worth watching. If it breaks above it, I'm bullish. As long as it stays below it, I'm bearish. So again, that's it for today. Hope everybody enjoyed it. I look forward to seeing many of you tomorrow morning in the trading room. And until next time, happy trading. I think gold has finished its downtrend. I'm still bullish gold. We've been bullish gold now for 1, 2, 3, 4, 5 days. Ever since we had the TriStar Doji pattern. I sent out a signal that night when before the markets opened saying I was bullish gold due to TriStar Doji. So I'm still bullish gold right now. We'll see where it gets to. But if you just bought there as soon as that opened, I mean, you're up $60 right now. So not bad. I'm not entirely convinced that it's completely done with this downtrend, but what I will say is your weeklies are strengthening, your momentum is strengthening. Just bottomed out. I'd like to see gold get at least back up to that 1430, 1440 level, retest these previous highs. So we'll keep an eye on it, but nothing looks bearish in it at the moment, to me anyway. So again, that's all for today. Hope you enjoyed it. Thanks for coming. God bless and have a great evening.